Kevin here had some questions.
So now, I know you're eating. But when it comes to money, tell me one thing. Between mutual funds and I.U.L.
Mutual funds and I.U.L.
Yeah. What would you suggest?
Between mutual funds and I.U.L, they're two different things. So a mutual fund is investing in somebody else's company. There's a family of funds, like a Fidelity, right? It's a bunch of mutual funds inside of. If I want to buy Coca-Cola stock, right? I have to buy Coca-Cola stock, one company. With a mutual fund, I'm buying a lot of different companies. It's like us putting our money together to buy one stock at a fraction. You're spreading your risk in a way without taking full risk with one company. Because whenever you invest, you're loaning money to a company. That's basically the bottom line. You're giving somebody money for them to use it to grow their company. And then if they make a profit, you make a profit. But if they lose,
you go down too.
And what happens is it's also controlled by the economy. Like when COVID happened, a lot of stocks went down, right? People lost money. But now when you talk to a financial advisor, hey, wait for the market to go back up. It's paper loss.
Yeah.
Those guys.
They tell it's paper loss. But then how many years do you have to wait, depending on when the market crash? Now, of course, when you're younger, it's a different conversation. But still, one question I always ask people, how much of your hard-earned money do you want to lose?
None.
I.U.L, Index Universal Life, is basically you packing your money with an insurance company, and the insurance company is taking the risk for you. So you're not really directly investing in the market like most people think they're investing in the market. They're not investing in the market. The insurance company is the one investing, and then they're mimicking the market. They watch what the S&P uses. If the S&P goes up, they'll give you a return. And now every insurance company is different how they calculate the returns. Because some of them, they might say, oh, we're going to pay you cap 10%. But is it really 10% cap you're getting? And then what about the fees? A lot of people don't think about that. The fees inside of it. So it's very important, the I.U.L company you're dealing with. But unfortunately, some of these insurance agents, they're just selling product. Because everybody's in business for commission. Everyone, No, we don't mind you getting commission, but I want you to educate correctly. So that's what we do differently. We like to educate our clients so they understand why they're going into those things. So there's a difference between the I.U.L and the.
So if I ask you a question again, so you're telling me that I.U.L is a place where I pack my money. Then after that, I can now go do the risky part, which is now the mutual funds. So if it goes down, I don't have to bother myself because now my money is packed in a safe place where it grows over time, right?
Right.
Fantastic.
If you want to continue investing in mutual fund, then you could take a loan against your I.U.L to do it. I don't advise that. But here's the thing. People should understand first. You're familiar with trust and wills, right? Do you know what a trust and will is? What is it? Can you explain? She got foot in her mouth.
Okay. All right. So a trust, from my own understanding, a trust is something that has, let's say, for instance, you have a title, you have a mortgage, you have
title.
Anything that has title goes into a trust. It gets protected.
Right.
But now a will, things that don't have titles, like jewelry or any stuff, goes into a will.
And the will can be contested.
Yes.
Right.
Which means somebody could still contest it and say, oh, he was meant to leave me that stuff. And then it goes to court, probate court. So a trust kind of makes your asset protected and private transfer. So you're transferring stuff privately so that nobody knows you give somebody stuff privately. That's what a trust is. Make sense?
Do you need to have a certain amount in order for you to open a trust? Must the estate or whatever you own be on a certain amount?
Well, the assets. The asset is the key.
Okay.
So a house is not an asset until it's paid off. Because in the eyes of the bank, it's a liability. The only time the bank counts a house as an asset is only if you're selling it. Okay? When you're about to close the property. Of course, when you pay off your house, the cash inside of it, the equity, the cash, becomes the asset, which now, if somebody's going through a divorce or whatever, they split that money. When they have to sell the house to get the money 50-50. Make sense? So that's an asset for that person that's getting it. Or it's an asset for somebody when somebody dies, the person that's inheriting the house gets that cash because they're going to sell it anyway to get the money.
Right.
Key is the money. So now here's the question. In addition to your house, right? Because that's one thing. But something purchased the house. Did they give you the house for free?
No.
So what's paying for the mortgage every month?
Your income.
Yeah.
Your income. So that's one. Income, number one. Now, what's protecting your income? Because your income is your most valuable asset. How did you create the income?
I worked.
Your mindset,
Right.
your skill, right? Your skill produced the money. That's the income. Now, when the money comes in, like let's, for example, okay, right now, let me show some cash, right?
Hey.
So I got cash. This is all cash, right? You know, I say ladies like money. Everybody likes money. Nobody doesn't like it. But this money is useless right now. It's like, Douglas, do something with me. Spend me. Protect me so I could protect you. You keeping this money right here, it's useless. It's not doing anything. The money wants to go do something. It says spend me, right? If I give it to you, you know what to do with this money, right?
Sure do.
Sure you do.
You know what to do with it.
Yeah.
Everybody knows what to do with money. That's why people, hey, oh, give me money, give me money. Everybody knows what to do with it. The money saying, I don't want to sit here. You're making me lazy. Because I could go on vacation. I could pay for a bag. I could do different things, right?
Shoes.
I could buy shoes. I could do whatever. See? So now when you make the money, using your mindset to make the money, how are you protecting your mindset and this money?
I get that life insurance.
Thank you.
Yeah.
So that's where life insurance comes in. The life insurance, you take the money, $50, let's use that example, and you purchase life insurance. Let's say you buy term insurance that protects you. You're using $50 to buy 500,000. You use the penny to buy $1, right? That's one. Now, you want to buy casual life insurance. Put another $50 in there. So now it's split. The same amount of 500,000. Now, $50 goes to protect the 500,000, which protects your value. The other 50,000 goes to earn interest and starts growing. So it depends on the type of plan you have. You have this whole life and there's I.U.L. Whole life is like, depend on how we design it, because we design it. Because I'm the architect. I'm going to design it so that when you put money in here, instead of you putting money with Bank of America, I'm going to give you, put the money so you could access it right away in case of emergency. But if there's no emergency, you keep adding to it every month. It keeps growing. Every month, you keep adding it, growing. You're not interrupting the growth of it. Now, when there's an emergency, so you go to the insurance company and say, hey, Mr. Insurance Company, give me your money because I have money here. My money is grown. I want to use mine as collateral. And the insurance company says, how much you want? Oh, I just need $50. They say, here you go. You're going to pay us interest? Sure. How much interest? Let's just say $20. But I'm already growing this because it's here. This is simple interest. This is compounding interest. Guaranteed growth. And it's safe.